Welcome back to the Deep Dive. Today we're taking a close look at Novavax, ticker NVAX. It's a biotech, currently trading around $8.45.
Yeah, and this isn't your standard story. This company is attempting, well, one of the biggest, riskiest strategic shifts you could imagine in biotech.
Right, trying to go from this pandemic giant to something much leaner, focused purely on R&D, shedding that whole pandemic era setup.
And that massive shift, that pivot, is exactly why the numbers are, well, frankly, all over the place. It's a huge contradiction.
Lots.
Well, you glance at the surface figures, maybe the earnings from the last 12 months, and you think, wow, the stock looks incredibly cheap. The market price seems low compared to those earnings.
Okay, so potential hidden value. That's what it looks like at first glance.
Looks like it, but,
Yeah.
In biotech especially, what seems like a bargain can often be a value trap.
Right. See that before.
Exactly. So if you push past those, frankly, misleading earnings numbers and really dig into the underlying cash flow, which is, the actual engine of value.
The real money moving in and out.
Precisely. One very solid model we looked at, focusing on that cash flow, suggests the intrinsic value for Novavax is actually closer to $2.47 a share.
Wow. Okay, so $8.45 market price versus a $2.47 fundamental value based on cash flow.
Yeah.
That's enormous.
It's a colossal gap, and that difference really captures the whole investment puzzle here. It signals this deep, deep skepticism from the market that we really need to unpack today.
That's definitely the hook. Can the management actually bridge that huge gap? Or is this whole thing just sort of a financial illusion?
Yeah.
That's what we need to figure out by going through these sources. But first, just a quick word for everyone listening. We want to make sure you're getting the absolute best insights. So please like and subscribe to the Stock Analytics AI YouTube channel.
Yeah, definitely do.
For just €4.99 a month, members get access to this huge playlist, 500 deep dive videos covering every single S&P 500 stock. It's massive. And next up, just for our members, we are tackling the NASDAQ 100. Plus, members, remember you can suggest stocks for future deep dives. Right in the comments, just drop the ticker, and we'll get on it for you. All right, so for today's deep dive on Novavax, we'll break it down. First, part one, looking at the core stuff, the business, the management, and those tricky financials.
And then in part two, we'll get into the market sentiment, who actually owns the stock, the major risks, and wrap it all up.
Sounds good. Let's jump in. Hashtag tag chapter one, business understanding.
Okay, chapter one, business understanding. Let's start with that huge strategic pivot. What does it actually mean for Novavax day-to-day, going from doing everything to this lean model? And how vital is that Sanofi partnership?
Well, the pivot is basically admitting their old way wasn't sustainable. Historically, they tried, the whole vertical integration thing, R&D, large-scale manufacturing, global sales.
Doing it all in-house.
Exactly. And they stumbled pretty badly, actually, on the manufacturing and commercial side during the pandemic response. So the new model, under the current CEO, John Jacobs, is about outsourcing those really expensive, complex parts.
So manufacturing goes to specialists.
Right, like the Serum Institute in India. And crucially, the commercialization, the selling and marketing of their main COVID-19 vaccine is now largely handled by Sanofi, the big French pharma company.
Okay, and that switch must completely change how they earn money then. Your sources describe the new revenue as lumpy. Why lumpiness?
Yeah, lumpy is a good word. It's because they're not getting that steady, predictable income from selling vials of vaccine anymore. I mean, product sales were down to just $11 million in Q2 2025. Chump change, really.
So where's the money coming from now?
It's now driven mainly by things like licensing fees, royalties, and these big kind of one-off milestone payments. The perfect example was that $175 million they got from Sanofi.
Right, when the FDA approved the updated vaccine.
Exactly. That single payment basically funded their entire quarter. So very dependent on those big hits, not a smooth stream.
Makes sense. Let's talk about the actual product then. Nuvaxovid is the only one they're selling commercially. What makes it different, especially when you've got the mRNA giants like Pfizer and Moderna dominating?
Its key difference is absolutely vital. It's a protein-based vaccine. It's not mRNA technology.
Okay, so more traditional vaccine tech.
Exactly. And for some people, maybe those hesitant about the newer mRNA platform, or maybe with certain health conditions, this older, more established protein subunit approach is preferable. The latest version, targeting the JN.1 variant, got approved in August 2025 for older adults and high-risk groups.
But I gather the real crown jewel, the asset everyone's watching, isn't the vaccine itself, but the Matrix-M adjuvant. Explain that a bit. What's an adjuvant, and why is this one special?
Right. Matrix M is arguably their most valuable piece of technology long term. So, an adjuvant is basically an ingredient you add to a vaccine formulation to boost the immune response.
Make the vaccine work better.
Essentially, yes. Elicit a stronger, maybe broader, and definitely more durable immunity. Matrix M is derived from the soapbark tree. It's saponin-based, and it's proven highly effective.
And the key thing is, they can license it out.
That's the crucial part. Its value isn't just for their own vaccines in the pipeline. It's a technology platform they can license to other companies. Potentially very high-margin licensing deals, maybe even outside of vaccines, like in cancer therapies, perhaps. That's the long-term hope.
Okay, unique tech, potential licensing goldmine. But let's ground ourselves in the present market reality. An activist investor, Shaw Capital, apparently shared a pretty stark statistic about their current market share.
Oh yeah, Shaw Capital pulled no punches. They really highlighted how tiny Novavax is right now in the actual vaccine market. Their source pointed out that in the current season, Novavax administered something like only 7,000 doses.
7,000. Compared to?
Compared to about 6 million doses from their mRNA competitors. So yeah, they're completely dwarfed in terms of sales volume.
So their competitive advantage isn't sales volume at all.
Not right now, no. It's really that validated technology platform, the protein nanoparticle plus Matrix M, and importantly, the logistics. NVAX uses standard refrigeration.
Ah, much easier than the deep freeze the early mRNA vaccines needed.
Exactly. That standard refrigeration stability is a genuine advantage, especially for global distribution.
Hashtag tag chapter 2, management evaluation. Okay, moving on. Chapter 2, management evaluation. John C. Jacobs took over as CEO in January 2023. His mission seems to be fixing the company's, well, let's call it a checkered history of execution. How's he doing?
Well, he was definitely brought in specifically because of his background in commercial success. The idea was to directly address the string of failures and delays under previous leadership, especially around manufacturing and actually getting the vaccine out the door during the pandemic rush.
So he's the turnaround guy.
That's the mandate. And you have to understand, his aggressive cost-cutting and asset selling make more sense when you remember Novavax's history. They had this near-death experience back in 2019.
After the RSV vaccine trial failed, right?
Exactly. The stock plummeted, went below $1. They were really on the brink. So that memory, that crisis is absolutely driving the current shred assets, stop the bleeding strategy.
And we're seeing clear evidence of that shredding, aren't we? The divestitures.
Absolutely. They're actively dismantling that old, expensive vertical structure. They sold off their Czech manufacturing plant, got $200 million from Novo Nordisk for that.
And just recently, the headquarters lease.
Yeah, big news. In October 2025, they transferred their Maryland HQ lease over to AstraZeneca, got $60 million cash up front, and it's estimated to save them something like $230 million in future lease payments. That's decisive action. It's all about becoming leaner, more agile.
But, okay, here's where it gets confusing again. The financials show a trailing 12-month return on invested capital TTM, ROIC, of over 30%. That's supposedly top-tier performance. How does that square with a company desperately cutting costs?
Yes. The ROIC figure, that 30.55% number is, let's be blunt, it's the ultimate financial mirage in this story right now. Completely. If you just look at that metric in isolation, yeah, it looks fantastic, top percentile. But you have to understand the context. It's an anomaly. It's entirely skewed upwards by those huge non-recurring payments. The Sanofi milestone, for instance, and the cash they got from selling assets like that Czech plant and the HQ lease.
So they're not actually earning that return through efficient operations.
No. They're essentially selling off parts of the company to generate cash, which then makes the return calculation look amazing for that specific period. It's an accounting boost driven by one-offs, not a reflection of stable, profitable core operations. Big difference.
Hashtag tag chapter 3, financial analysis. Okay, that leads us perfectly into chapter 3, financial analysis. This is where we really see the impact of that strategy. Novavax is small cap now, market cap around $1.38 billion. But the revenue journey has been, well, you called it whiplash.
Total whiplash is right. Revenue shot up to almost $2 billion in 2022, peak pandemic demand. Then it just crashed in 2023. Now, the current TTM figure is back up to about $1.08 billion. But again, that's inflated by the lumpiness we talked about, those big one-time partnership payments, not steady sales.
And those lumpy high-margin licensing fees must be distorting the profit margins too, right? We see TTM gross margins way up near 88% and a net margin around 39%. Those look fantastic on paper.
They do look fantastic, but again, context is everything. An 88% gross margin. That's what happens when your revenue is a licensing fee or a milestone payment. There's almost no cost of goods sold associated with that kind of income.
Okay. So it's not like they're making an 88% margin selling actual vials of vaccine.
Exactly right. These sky-high margins reflect those specific high-margin transactions, not the underlying profitability of their core long-term business model. They are totally misleading if you're trying to gauge the company's sustainable health. For that, you need to look elsewhere.
And that elsewhere is the free cash flow, isn't it? That seems to be the critical weakness.
That's the #1 metric to focus on here, the TTM free cash flow. It's deeply negative. We're talking negative $668.4 million.
Wow. Minus $668 million. So even with the asset sales, the milestone payments, the positive accounting profits, the business itself is still just hemorrhaging cash.
Massively. Every single year, it's consuming huge amounts of cash just to operate. And that level of cash burn, well, it's fundamentally unsustainable over the long run. They have to fix that.
And the balance sheet shows the strain of that, right? High debt.
Yep, the financial leverage is definitely high. The debt-to-equity ratio is concerning, somewhere between 4.5 and 6.1, depending on how you calculate it. That's a heavy reliance on debt.
But they have improved liquidity recently.
To their credit, yes. Those asset sales, like the check plant and the lease transfer, have definitely helped bolster their short-term cash position. Their current ratio is up to 2.36.
Meaning they can cover immediate bills.
Exactly, which is crucial given how much cash they've been burning through historically. It buys them breathing room.
Okay, this all brings us back to that valuation paradox we mentioned at the start. The trailing PE ratio is incredibly low, like 3.2 to 3.8. The biotech sector average is way higher, around 17x. Why isn't Wall Street piling into this seemingly cheap stock?
Because, as we discussed, it's the textbook definition of a value trap. That low PE is based on the eat the earnings, which we now know are artificially inflated by those non-recurring windfalls.
The market sees through it.
The sophisticated market participants certainly seem to. Just look at the forward P ratio, which is based on analysts' expectations of future earnings. It jumps to a staggering 121.88.
And 121 from 3.5.
Yeah. That huge leap tells you the market has virtually zero confidence that the recent high earnings are repeatable or sustainable. They expect earnings to fall off a cliff.
And this lines up with that intrinsic value calculation you mentioned earlier, based on cash flow.
Precisely. When you run a discounted cash flow model, which focuses on future cash generation, not accounting earnings, and you penalize Novavax heavily for the unpredictability and riskiness of those cash flows.
Which you have to, given the history.
You absolutely have to. That model spits out a fundamental intrinsic value of only $2.47 per share. So the current market price, around $8.45, it's trading heavily on hope, on the turnaround story succeeding, not on current demonstrated sustainable financial performance.
Hashtag CAG Chapter 4, Market Sentiment. All right, Part 2. Let's talk market sentiment, ownership, and risk. Starting with Chapter 4, market sentiment. The fundamentals look shaky, cash flow is negative, yet the stock price is holding up above that intrinsic value. What's the mood on Wall Street? Analysts seem divided.
Oh, completely divided. It's actually quite striking. You look at the price targets from different analysts covering NVAX, and they are just all over the map.
Like, what kind of range are we talking?
Well, the low end is down around $6 per share, really quite bearish. But then you have optimists setting targets as high as $26.25.
$26. That's a massive spread from $6.
It's huge. And when you see professional analysts disagreeing that violently, it basically means nobody really knows. They're essentially placing bets on whether this strategic pivot, this turnaround plan under Jacobs, will actually work. There's zero consensus.
Okay, so analysts are uncertain. But is there a clearer signal of market skepticism somewhere else? Like short sellers?
Ah, yes. The short interest. That is probably the single most telling indicator of the underlying bearishness here.
How high is it?
It's very high. Depending on the source and exact timing, somewhere between 30.95% and 33.58% of the company's entire float, the shares available for public trading, is sold short.
A third of the float. Wow.
Yeah, think about that. That means a huge chunk of sophisticated, often institutional investors are actively betting significant capital that the stock price is going to go down. It makes Novavax a classic battleground stock. Bulls versus bears fighting it out.
Yet, despite that huge short pressure, the stock's technicals show some strengths right now.
They do, which adds to the complexity. As of late October 2025, the stock price is actually trading slightly above both its 50-day moving average, which was around $8.38, and its 200-day moving average, around $7.62.
So near-term momentum is positive, even with the shorts piling in.
It suggests that for every seller or short seller pushing down, there's been enough buying pressure maybe from retail investors hoping for a squeeze or turnaround funds betting on Jacobs to keep the price relatively buoyant recently. It's tug of war.
Hashtag Chapter 5, ownership structure.
Yeah.
Okay, Chapter 5, ownership structure. Who actually owns these shares that are being fought over? It sounds like a pretty mixed bag.
It's definitely a complex ownership structure, and you can really see three main factions, often with conflicting interests.
Factions. Okay, like who?
Well, first you have the big passive index funds, Vanguard, BlackRock, the usual suspects. They just hold it because it's in the indices they track. They provide some stability.
Yeah, passive giants.
Yes. Then you have the disruptor. Shaw Capital, the activist investor we mentioned earlier, they've taken a significant stake and are very publicly pushing for the company to just sell itself entirely.
So they want a quick exit, unlock value through a sale, not wait for the turnaround.
Exactly. They're impatient, applying pressure for M&A. And then the third group is the strategic corporate partners. Think Sanofi, who relies on Novavax for their deal, and also SK Chemicals in South Korea, another key partner.
And they presumably want stability and long-term success for their collaborations.
Right. So you have passive holders and activists pushing for a sale, and strategic partners needing operational success. It's potentially messy.
What about the insiders then? The execs, the board members, people who really know what's going on. Are they buying the stock, seeing value at $8.45?
Well, the trend there, looking over the last 12 months, according to the sources, is actually pretty bearish.
Oh, how so?
There were apparently 13 instances of insiders selling shares versus only 2 instances of insiders buying shares on the open market.
13 sells, 2 buys. That's not exactly a vote of confidence.
It's not. Now, insiders sell for many reasons, diversification, taxes, whatever. But the lack of significant open market buying by insiders does suggest that those closest to the day-to-day challenges don't seem to view the stock as dramatically undervalued at its current price.
Hashtag Chapter 6, risk assessment.
Okay.
Chapter 6, risk assessment. We've covered a lot of the internal stuff, the shaky execution history, the negative FCF. And the opportunities are clear, too, the pipeline, like the combo flu COVID shot and maybe wider licensing of Matrix-M. But let's focus now on the biggest external risks facing Novavax.
Yeah, and there's one external risk that jumped out from the sources as being particularly immediate and, frankly, potentially devastating. We need to talk about geopolitical risks specifically related to U.S. trade policy.
Okay, what's the specific threat?
In September 2025, there was an announcement about a potential new U.S. policy. It involves slapping a possible 100% tariff on imported branded or patented pharmaceutical products.
100% tariff. On what grounds?
The trigger would be if the company behind the drug isn't actively investing in building up its own manufacturing capacity within the United States. It's part of that push for domestic supply chains, especially for critical medicines.
Okay, I see where this is going. Novavax's new lean model relies heavily on overseas manufacturing, doesn't it?
Exactly. That's a potential killer blow here. Their whole strategy involves outsourcing manufacturing, primarily to partners like the Serum Institute of India and SK Bioscience in South Korea.
So if this 100% tariff comes into effect,
and Novavax is importing Nuvaxovid manufactured overseas into the U.S. market, the very market Sanofi is supposed to be handling for them, that tariff could instantly make the product commercially non-viable. Doubling the cost basically kills the economics.
that jeopardizes the entire Sanofi deal, the cornerstone of the new model.
It absolutely could. It undermines the whole lean, outsourced manufacturing strategy, at least for the crucial U.S. market. It's a massive looming threat they have to address somehow, perhaps by bringing some manufacturing back on shore, which costs money they don't really have.
So even if we see some positive macro trends, like interest rates may be easing in late 2025, which usually helps biotech,
Right, easing rates would normally be a tailwind.
this specific geopolitical tariff threat just completely overshadows that potential benefit.
I'd say so, yes. An easing Fed might make borrowing slightly cheaper, but a 100% tariff on your main product in your main market, that's an existential threat that outweighs general economic conditions. It's the elephant in the room for their strategy right now.
Hashtag Chapter 7, conclusion.
Yeah.
All right, let's bring it all together. Chapter 7, conclusion. Can we summarize the bull case one last time? If you're optimistic about Novavax at $8.45, what's the core belief?
The bull case is essentially a bet on execution and technology. You believe the strategic pivot is the right move, that shedding the costly manufacturing and commercial arms was necessary. You're betting on the new, leaner management team, led by Jacobs, to successfully execute this turnaround.
And you believe in the core tech.
Yes, fundamentally, you believe in the value of their unique, validated technology platform, especially the Matrix and adjuvant, and that the Sanofi partnership provides both crucial validation and needed capital, effectively de-risking the path forward somewhat.
Okay, now the bear case. Why the deep skepticism, the massive short interest?
The bears look at the long, painful history of poor execution and missed deadlines. They focus relentlessly on that persistent, devastating negative free cash flow. The company just keeps burning money.
They see the recent profits as illusions.
Exactly. They see the reliance on lumpy, unpredictable milestone payments as hiding fundamental operational weaknesses, not solving them. And crucially, they see that massive external threat from potential U.S. tariffs as a potential checkmate against the current strategy.
So it comes back to where we started. That huge gap between the current market price of 8.84 thousands and that fundamental cash flow-based intrinsic value estimate of just $2.47 per share.
That gap says it all, really. Novavax, right now, is the absolute definition of a high-risk, potentially high-reward gamble. If you buy the stock today, you are not buying proven performance.
You're buying a bet on the future.
You're betting entirely on the ability of this management team to achieve something the company has literally never done in its entire multi-decade history. Generate sustainable, predictable, positive free cash flow from its core operations. Until they demonstrate they can actually do that quarter after quarter, expect the volatility and the deep market skepticism to continue.
A very clear, if challenging, picture. That really distills the core tension. Thank you for walking us through all that detail from your sources.
My pleasure. It's a fascinating case study.
Absolutely. Okay, everyone, that wraps up our deep dive on Novavax. Remember to like this video and subscribe to Stock Analytics AI for more deep dives. Members get that huge S&P 500 playlist, the upcoming NASDAQ 100 coverage, and can request stocks in the comments.
And finally, the necessary disclaimer. This analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.